In this week's update, global stretch marks lengthen. A commodity-heavy portfolio is rapidly becoming the best bet, and gold surges on the Iran war. My name is Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Well, a lot has changed since I prepared the bulk of this presentation. Obviously, the war with Iran makes things a lot more uncertain and changes many things. So I'll do my best to walk through it, but look, to be honest, it's so fluid, the situation at the moment, that really you can't make any conclusions. So the immediate consequences of what's just unfolded over the weekend is that there are, I would have to say at this stage, probably still unconfirmed reports that the Straits of Hormuz have been closed, or at least are being avoided by shipping companies. So whichever way you slice it, that means that there is a restriction to the transportation of oil around the world, because this is one of the most significant passages that there is. So that undoubtedly will have a big impact on the oil price. Now, whilst the precious metals market is not open over the weekend, there is 24/7 trading on physically backed tokens such as Tether Gold. And there's been a big jump there, and that implied about a $350 jump in the price of gold. Also, the similar thing has happened with Pax Gold as well. And that, I guess, is no surprise. So I would expect that gold equities are probably going to do proportionately pretty well when we open for business again on Monday. And just interestingly, whilst a lot of people may never heard of Tether Gold, it's now one of the world's biggest buyers of gold, right up there with many central banks in terms of their impact on the demand side of the market. So that is a significant indication of what's to come. Now, there's been a lot of erratic trading over the weekend, but risk assets are down, including Bitcoin. So I think we're going to see a typical reaction to the start of war on Monday, but also typically the reactions in the equities market at the start of a war, which is kind of expected, tends to pass fairly quickly. So this may not be as bad as what some people might think. It's almost certain that oil is going to spike up very hard as a consequence of this. But look, there's a lot of things in the air, so there's no point in trying to make a guess at it or to try to think it through what might happen. Let's just wait and see how it unfolds and respond to that. But I think it can only enhance the trends that we've already had in hard commodities that have been going on now for quite some time. It's hard to see that it's not going to be a net positive there. So that's where we sit at the moment. So these are some bigger picture thoughts on what was well and truly in place and has been building for a long, long time. The first one is that the West financial system, or their dominance of the world's financial systems, is getting very stressed and is heading in a fairly definite direction that is not what anybody in the West would want to see. And the non-Western world is really creating a parallel architecture here, architecture for settlement, for one thing. So the change is structural. It's going to be with us for a long period of time. And it's also would appear to be irreversible when you look at the nature of the changes and what's driving it. So this is a very, very significant point in time, and we're going to see very significant changes in the world's global financial system in the next 5 years. I think that's inevitable. It's also inevitable that price discovery, we're seeing it right at the minute. Price discovery is moving from west to east. If you look at precious metals, price discovery occurred in London and New York, and now increasingly that price discovery in gold and silver is occurring in Shanghai. And where the price discovery is occurring translates to power over the world's financial system. Liquidity is also migrating with that as well. These are changes that are absolutely massive, and they're not going to turn back the other way anytime soon. And so we're going to see the historic dominance of the NYMEX the Intercontinental Exchange, the LME, the CME, all being challenged. So we'll look back at this time in a couple of years and you'll be able to recognise the enormous changes that have happened. The settlement within China's infrastructure that's dramatically shifting the balance, the settlement of futures contracts. So a great deal of change. And then on top of that, you've also got the network effect of what's happening in the block of countries that are non-Western countries. And the net result of all this is that we're having to duplicate systems in hard commodities and processes at a time when there has been massive underinvestment for decades and demand for other reasons is outstripping supply. And then on top of that, we're going to have additional duplication. So it really is enhancing that trend towards strength in hard commodities. So financial markets are becoming a bit of a guessing game, and this really gets to the point that I've been making for a couple of years now, and that is, how can anybody possibly forecast 6 to 12 months out with any sort of confidence or any sort of repeatability? And that's what markets typically try to do. They try to price things 6 to 12 months in advance. But with everything changing so rapidly, not only due to AI, but now because of all these geopolitical events, forecasting 6 to 12 months out is just complete rubbish. So that brings us back to the point that fundamentals and their impact on prices, whether you like it or not, whether you agree with it or not, have far less significance than they used to. So respecting current momentum has to be the primary signal. Because if you're backing fundamentals to eventually translate through to the price, then an enormous amount of damage can be done to your wealth situation, to your stock portfolio, before things perhaps get back on track in respect to the fundamentals. So I think unless you've got absolutely ice in your veins, no emotions, and you've got at least a 10-year time horizon, then using fundamentals to be the main decision driver for what you buy and sell has very significant difficulties, and existing momentum needs to be given a lot more importance. And of course, all this means in a more uncertain, more volatile world is that you need to be far more prepared than has ever been the case before in history. Let's look at the American market. The S&P was down 0.5% for the week, and the Nasdaq by about 1%. But these indices, of course, hide an enormous amount of bifurcation underneath the surface. The Russell was down similar to the Nasdaq, a little bit more, but the rotation continues. However, very late in the week, we did see software give a bit of a bounce, but it's only a couple of days old. It's from oversold. It's quite possibly short covering. It may not go anywhere, but it's just something to keep an eye on, because there are some very, very good US and global software companies that have been sold off, along with all of the lower quality companies as well. So it's a very unpredictable situation at the moment in US technology, and that's why you really have to be guided by where the momentum is and not what the fundamentals would necessarily indicate. The US dollar index was down a little bit, 97.65. It'll be really interesting to see what the US dollar does into the start of the new week. The 10-year yield fell below 4. Again, what will the bond market reaction be to what's happened in the Middle East? And the VIX is almost certain to spike. It finished the week at 19.9, but it's almost certainly going to spike well into the 20s on Monday. Let's go and look at some charts on the US. So this is the Nasdaq, just for the record. And nothing has changed here from what I've been saying over the last 3 or 4 weeks, and that is that we've deteriorated quite quickly from looking like we were about to break out. There was an upward bias to these peaks and troughs, and now that has hit a double top at the end of January, and February has just been forming lower highs and lower lows. So we've actually got a 1-month trend to the downside, and this does nothing to dispel the possibility that we may have seen an index peak in the market. And if we look at some of the ratios that are important, this is consumer discretionary versus consumer staples, and it continues to fall. Money is moving more defensively, and that was exactly what it did at the end of 2021 and into the start of 2022. And we ended up with the US technology sector falling for 12 months. Didn't hit bottom until December of that year. So that is a very significant trend that's occurred during February. Semiconductors have remained strong, and that's still in uptrend. We're still sitting around about the 20-day moving average on SMH, which is an ETF for the semiconductor sector. So that will be important how that trades at the start of the week. Let's look at it on a sector basis. Energy and materials really took off last week, and you'd have to think that with the oil price certainly spiking hard, or I would expect it'll spike very hard when we reopen on Monday, and similarly with gold and possibly other commodities as well, that this is just going to continue. Next down the line, we've got the industrial sector and then staples before we get down to some of the other sectors that have been definitely lagging. So these sectors, energy, materials, industrials, and consumer staples, clearly differentiating themselves from the rest of the market. So that's the US, and I don't see that relative sector relationships changing with what's happened over the weekend. This is the Australian market. Materials clearly at the top. BHP and Rio had very, very strong weeks last week that have led to this surge. Then we've got energy and finance. So they're the only three sectors that are above the ASX 200, which kind of sits in the middle. And the S&P on a weekly chart, I'll just put that on a daily chart just so that we're looking up, comparing apples with apples with the NASDAQ. The rollover and the breakdown is not as marked as it is with the NASDAQ. So we've definitely got lower highs, lower lows, and that is kind of consistent with the fact that the market is moving more defensively. So there's been a bit of a change in character in that respect. This is the equal weight S&P actually hit new highs. So that's a positive sign because it's speaking to the breadth of the rally in the US. And there is the Russell 2000 for smaller cap stocks, and that is holding up pretty well also on a weekly chart. Turning now to the Australian market, the Aussie dollar finished at 70.55. It's just going to get chucked around by much bigger forces around the world next week. So I have no real feel for where the Aussie dollar might go. Certainly if commodities are strong, that will help support the Australian dollar. Our index was up 1.3% for the week, but I would expect that our market will start with a bit of a risk-off attitude. However, it's really hard to know what is going to happen there because materials could be quite strong. But I would expect that a good part of the Australian market will probably start off fairly weakly. Reporting season shows that the fundamentals aren't dead, but certainly the reactions in the market would indicate that life support for fundamentals as being the main driver of share prices is not that far away. So coming back to what I said at the start, and that is you just have to overweight current momentum far more than fundamentals. Otherwise, the consequences could be quite nasty. And of course, all of this is being driven because of passive investing, passive ETFs, algorithmic trading, high-frequency trading. There's just such a large part of the market that is not being driven by human valuations, decisions made on the normal valuation metrics. It's being driven by other factors, largely by computers. So BHP and Rio went exponential last week. That was really quite a spectacular move in those companies. Let's just go look at the charts there. So the ASX 200, you can see set a new all-time high. This is a weekly chart. We closed right on the highs. That will be highly likely to turn over during the week. It was materials, so that's XJR, the ASX 200 resources, which had a very, very powerful week and finished quite emphatically. We got a bit of a turnaround in the information technology sector. Hard to know whether that will continue or not. It's just a bit of an oversold bounce at this stage. Healthcare is still looking horrid, declining very, very sharply. And of course, banks have done very well, and energy also doing well in the Australian market. So moving now to precious metals. And I think the only question here is how much will gold and silver spike on Monday? Gold was up as far as the close on Friday night. Gold was up $168 or 3.3% for the week to just under 5,300. But indications are that we're a couple of $100 above that in terms of weekend trading that has been open. In Australian dollars, 74.18, and that's the highest close that we've ever seen in Australian dollars. And silver was up 11%, so a very strong week for silver to 93.82. Get to those charts in a minute. There is a physical silver squeeze on, which is it's both physical, but it's also structural. It's also long-term. It's almost impossible to see the supply and demand balance in the silver market getting back into a surplus situation. And China now controls the price. I was talking earlier about the move from west to east in terms of who is really controlling the settlement process. And China now effectively controls the price setting. So that's a major change. Now, central bank net purchases doubled in 2022 and have basically stayed at that extremely high level ever since. So that's been a massive step change in the behaviour of central banks. And given everything that's unfolded in the last 12 months with sanctions, geopolitical events, it's pretty hard to see that changing. And one way to look at this is that the gold price has really got to rise because there are plenty of marginal deposits out there that can be developed at gold prices in excess of 5, 6, 7,000, but they're not necessarily viable at the current price. So I think everything is pointing towards gold continuing to increase, and silver will almost certainly go with it. So it's pretty obvious where the price is going, and there's all sorts of predictions out there of $10,000 gold by a certain period of time. I think that's just plain silly to try and put a time frame on it. It's just the trajectory that's in question here, but little question that the price of precious metals is going higher. And when you consider the fact that we've got gold equities on a long-term basis are still undervalued relative to the price of gold, then gold equities have still got considerable upside ahead of them. GDX listed on the ASX was up 7.7%, and GDXJ listed in the US was up 10%. So some very significant moves there. And if we look at the charts, we'll start with silver, and this is on a daily chart. You can see we managed to hold this key support level, and we've now formed a higher high than the top of this bounce that we got in early February. So that was a very strong finish, and this is highly likely to be higher when markets open again on Monday. Gold on a daily chart also has continued to trend upwards, and it's been less volatile than silver has been. If we put this on a weekly chart, you can see just how dramatic this move has been in gold since February of 2024. So we're 2 years hence, but we've moved from 2,000 to 5,500. So that's been a very dramatic move, and it's showing no signs of the escalation slowing down. And in Australian dollars, that's how we finished the week. And I mentioned there, for those that are interested in silver equities, SILJ, which is listed in America, put on 11.5%. So that's the silver equities. Other commodities, copper rose to $6. Can't wait to see what it does when things open on Monday. But it's really important, and I hammer this point every week. You got to have a plan. You can't just turn up and expect to make money. Understand what your plan is. Keep it really simple. This is not a hard thing to do. In copper, how much of your portfolio is going to be devoted to copper? Is it 5%, 10%, 15%? You need to have a feel for what sort of exposure you want to have, because if you just start buying copper stocks, then you can end up with completely the wrong sort of exposure at the wrong time. And then the next decision point is, well, what is the mix between copper producers, copper developers, or are you better suited to ETFs? These are all questions that you need to answer before you buy anything, not after. It's too late then. But certainly the outlook for copper looks incredibly attractive. Now, crude oil finished at 67.02, but of course that is going to change quite dramatically next week. XLE listed in the States was up 2%, so the trends there have become pretty clear, and I wrote this on Saturday morning, geopolitical risk premium is mounting. Well, I think in the last 12 hours it's absolutely exploded. So again, another huge pocket of uncertainty. Here's the copper chart. Hopefully copper moves higher on this uncertainty, but it's really a lot down to what happens with the US dollar. Nickel finished at just under $18,000 a tonne, so it stays in the range that it's been in. Uranium spot is at $86.55. There are plenty of predictions talking about $150 to $200 for uranium. And if fundamentals have any meaning at all, then I don't see any reason why uranium won't get to that level. So I think we've got a major decade of a strong outlook for uranium stocks. There's the spot nickel chart in its range between roughly 17,000 and 19,000. And there's the spot chart of platinum. They're also continuing to move up very strongly in step with gold and silver. And there's the crude oil chart. Wrapping it up is achieving the sweet spot in the time frame that you're looking over. And it's somewhat elusive and hard to pin down at times. But looking at the extremes, if you're assessing the market too closely, then price moves have little relevance because they're just too short term, they're too random, they're too news driven. So you don't want to get too close to the market and be making conclusions on what might happen on a daily or weekly basis. On the other side of things, if your assessment of where the market's going is too far out, it's a couple of years out, or it's based on fundamentals, then you can do massive damage to your portfolio, which then in turn just shatters your confidence. And over the decades, I've spoken to plenty of investors who've had their confidence shattered by the last time the market cratered. So you've got to reach that sweet spot in the middle in terms of how you interpret what's going on. So we've got a market of extraordinary opportunity, and in recent weeks and months, I've been talking about the fact that we've got so many megatrends that have all come together at the one time, and all of them, to a large degree, look like they're unassailable. But this is not an environment for the casual investor to do well in. You've really got to be immersed in the market to be able to understand and anticipate how the market is going to react and what is the difference between a very short-term overreaction to news and what is something that is part of a structural trend. So it will not be an easy market, but it's certainly a market that's going to provide in the next 1, 2, 5, 10 years enormous opportunities for those that are organised and have got their act together. So it requires a sharp perspective, which is kept up to date, and being decisive as well. Most importantly is understanding what your actions are going to be and just be decisive. So that's it for this week. I'll be back with you next Sunday. I'm sure there'll be a great deal to report, and we'll see what happens during the week. Cheers.